Action Alerts Plus has been building up their stake in the tech sector. Now, Stephanie, you're adding to a couple of different names here, and it seems like you're betting that the second half recovery in IT spending is in fact coming. Is that the case?
Absolutely. I think that, well, first we could go through a couple of different names, but I would like to start with Cisco because it's at a new high. I would say that Cisco is up because we've gotten data points over the last couple of weeks from Juniper, from Ciena, hints from Cisco that the service provider market is actually starting to improve. We have waited 5 years for this, so it's been a very long time. If you get service provider spend as well as IT budgets start to loosen up a little bit, I think the stock could go a lot higher. It's still very attractive, and in the meantime, they're gaining market share versus their competitors. They're also transitioning away from the traditional core routing and switching, and that's more commodity-like business, and they're going more towards software services security. That's very, very important over time, and I think that's going to afford them a higher multiple as well.
Okay, we get earnings from them this week. Last time they missed big. What are you expecting?
Well, Oracle is this week. Oracle is this week, and that's a name that actually on the opposite side, we actually took some money off the table because its stock has bounced from the low when they reported back in March, that disappointing quarter. It bounced off the low. We sold our lower priced stock. I think they're going to do in line, but I do think that second half of the year guidance, or I should say, they're on a fiscal year, but the second half of the year will be conservative. They typically are conservative, and if the stock were to pull back, then we would buy back what we just sold. But I think you have to kind of be a little bit more nimble on Oracle, just because the visibility isn't as great. Yeah. But we still have exposure there too. It's just a little bit less.
Applied Materials is a newer one to the portfolio. What's the thesis here?
So Applied Materials is really on CapEx spending, and that's starting to improve. And we've heard it from Samsung, we've heard it from Intel, we've heard it from TSMC, and that actually is going to benefit the semi-cap equipment companies like Applied Materials. There's also a breakup value for this company, which I'm not sure you're going to see that anytime soon, but there's some of the parts you can get easily to $20 just on some of the parts. The Variant acquisition, you have synergies there. So we have been in Lam Research for so many years. We sold that, took gains, and actually bought this one, and we will continue to buy in the low 15s.
Okay, so you're bullish on the tech sector in general, but you're still underweight versus the S&P 500. Right. So are there any other stocks you have your eyes on to add to? You
know which one we've looked at for so many years, and we like it. We've been in it and out of it. It just hasn't come in. Is Accenture. Really like what they're doing. We would buy IBM back. We sold for a gain there as well. Those are two high-quality bellwether names that we like very much. And honestly, we still like Facebook. We're not giving up on that. I know a lot of people are, but we think that that's a longer-term story. You have to stay patient. But we do see the growth drivers, substantial growth drivers in that position.
Okay, tech is a sector that you will want to be involved in the second half of 2013.